Most people in crypto don't lose because of bad luck. They lose because they never understood the game they were playing. Crypto is fundamentally a PvP environment. Every dollar you make in this game, you're stealing it from someone else. So in this video, we're going to be going through the people that are getting stolen the money and how you can be the one to be making the big cash. We're going to be going through it in detail. I break down all the frameworks so that you guys can go away here and actually be a better trader by the end of the video. So let's get into it. Contents. The market's true nature, PvP dynamics. Why every single dollar you make, you're taking it from someone else. Structural failures. Why retail has zero edge. Edge means advantage. So why retail has zero advantage in the market. The behavioral biases that erode the edge. What's going on in these retail traders' head? Maybe you're making some of these mistakes and how you can actually fix them. The disciplines of the 1% trader. What the millionaires, the multi-millionaire traders are doing differently. Distilling the edge, discipline, asymmetry, and informational flow. And we're going through all of this. This is all from experience, guys. I've made every mistake in the book. I've been in crypto since 2017, and I've been trading full time since 2020. So I've made all of these mistakes now. I am more than a 1% trader now. So I'm going to teach you guys from experience as well what's worked for me. Let's get into it. The market's true nature, PvP dynamics. The market, crypto is not a cooperative game. I don't know if any of you thought that, but it's not. Fundamentally, it's PvP, where every dollar you make comes directly from someone else's pocket. Unlike equities or long-term business, crypto doesn't create cash flow. It's purely a transfer of wealth between people. So once you understand this, you stop looking for safe wins and start thinking in terms of outperforming other traders in a competitive arena. That is what it is. Let's put this in bold so you guys really drill that in. Negative sum dynamics. On top of being PvP, as if crypto was hard enough and being PvP, it's actually worse than PvP. It's a negative sum because little fees and transactions and slippage and MEVs and exchange spreads eat away at your capital. So that means that if you do nothing, the game slowly drains you. Pump Fund drains you, Binance drains you, Jupiter Exchange drains you, Phantom drains you. So to win in a negative sum environment, you must not only be better than average, you have to be significantly better. That's why crypto is so hard, but it's also very profitable. Hard doesn't mean it's not profitable. Hard oftentimes means that it's the most profitable thing. You just need to get good at it, which is why you're doing a very good thing by watching the video. PvE windows, player versus environment. Crypto isn't always PvP. There are moments in the cycle where external inflows flood into the system through ETFs, institutions, or waves of retail mania. During these periods, you're not competing head-to-head with hardened traders. You're extracting value from less experienced players and fresh capital entering the ecosystem. This shifts the game temporarily from PvP to PvE. And those who are prepared capture asymmetric wins. Recognizing these windows is one of the most valuable skills in the game. Recognizing when there's outside inflows coming in, and you're not just competing against crypto Twitter and people in your Telegram groups. You're competing against people outside of crypto. It's like stealing candy from a baby. It's easy, just like with Trump coin. Trump coin, you're competing against tons of retail that didn't have a clue what they were doing. If you're smart and locked in and bought in early, you would have made a ton of money. Structural failures. Why retail fundamentally has no edge. No system. Most retail participants treat crypto like a hobby, not a craft, not a discipline, not a career. This is my life, guys. This is my career. I stare at the screen 16 hours a day. Like, how do retail that treat this as a hobby and have a 9 to 5 expect to outcompete me? You're probably not, okay? This is the harsh reality. They have no rules, no process, no risk framework. Their entries are random. Their exits are emotional. They chase pumps, panic on dips, and repeat the cycle endlessly. Without a system, their results are indistinguishable from gambling. The difference between amateurs and professionals is simple. Professionals operate from a playbook. Retail operates from emotion. No understanding of asymmetry. Asymmetry is the lens, it's the filter that I use on every single trade setup I take. The downside must be capped, the upside must be multiples larger, especially in crypto. This is exactly what I did when I got 100x on Lofty. Plus 100x. It was more because I bought in at 1 million market cap and it ran all the way to 240 million. Obviously, I wasn't holding all of it till then, but the point stands. Retail does the opposite. They buy coins after 50x runs, risk thousands for the chance at crumbs, and ignore setups where small bets can turn into life-changing gains. If you don't understand asymmetry, you will always be the one providing liquidity. So look at this. Asymmetric here in Lofty. This is where I bought, and it ran all the way up. I knew that the downside was limited. We're not going to get into it this video. Maybe another video we can get into it. But I knew it was limited. I knew that the potential upside was a lot higher than the downside. That's why I bought. Okay. Undefined archetype. Most retail traders don't even know what they're doing. Are they long-term investors, short-term traders, meme coin traders? Are they builders? They don't have a clue. They just contradict each other. They're never going to win. Imagine going to university and thinking to yourself, oh, I might do history, or maybe engineering, or maybe politics, or maybe math. You're not going to be good at any of them. You have to choose your lane, okay? Short-term thinking. Retail doesn't think beyond the next pump. Their entire worldview is compressed into 24 hours of price action or whatever is trending on Twitter. This keeps them permanently reactive. They chase instead of actually positioning. They ignore structural forces that actually drive the markets. Things like institutional inflows, macro liquidity, things we talk about in this channel. Cycle timing, because those require patience and discipline. The behavioral biases that erode edge. Impatience and ego. Most new traders arrive with inflated expectations. They've seen stories of overnight millionaires and assume that they can replicate the outcome immediately. And the truth is, in crypto, you do get overnight millionaires. But they had built a skill set that was required to become a millionaire years and years before. You don't just become a millionaire overnight. You put in effort. It's like a bamboo. Bamboo grows in the seeds and grows underneath, and then it suddenly spikes up. That's what happens in crypto. You have to put in the work first. You have to overcome all the mistakes that retail make in that I'm telling you in this video. It takes a while, okay? Unless you're smart and you're watching this video and you actually apply what I'm telling you straight away. This impatience drives them to size too big, chase volatility and overtrade without a plan. When early wins come, they interpret it as proof of skill rather than luck, which inflates their ego even further. The market punishes this combination ruthlessly, and only those who learn to put patience before pride survive long enough to compound. Mistake reinforcement. One of the most dangerous loops in trading is when a trader makes a poor decision and profits. So they buy a coin that randomly at the top of a hype cycle. So they buy a coin that is a bad coin to buy, but they still make money. And then they think to themselves that, well, my system works, so I bought the coin. Okay, Hades told me I shouldn't have bought the coin, but I already made a 5x on it, so I'm going to do it again. And eventually they do it with even more capital and get wiped out. So it's a time-delayed disaster. I've seen people blow up from this before, unfortunately. So this is what it is, right? You got an ego overconfidence, mistake reinforcement. They make a trade that is fundamentally a bad trade, but make money. And then they get overconfident and blow up. Weak profit-taking muscle. Most traders lack the discipline to take profits consistently. They always believe they'll be one leg higher, and by the time they consider selling, the move is already reversing. I treat profit-taking as a trained reflex, not an emotional debate. Every time I skim into strength, I remind myself that is how edge compounds. Retail hesitates, the 1% execute. Without a strong profit-taking muscle, even great entries are wasted in potential because you're just gonna round trip. You guys have probably done this before. Great entry, but that's only half of the equation. And then coin round trips. What's the point? You need to learn to enter well. Okay, great, but learn to exit even better. Break even, anchor, and bias. Traders often anchor to their entry price, telling themselves they'll sell when the position gets back to break even. This psychological trap locks them into weak trades, preventing them from reallocating capital to higher conviction setups. Anchoring creates paralysis instead of cutting early and moving on. Retail sits in dead positions, wasting time and opportunity. Professionals like myself, I accept losses quickly. I understand that I don't want capital stuck in a bad trade, and I just fucking sell. I sell. I don't wait for it to get back to break even. Chasing tops and FOMO. Retail is wired to buy strength at its peak. They wait for confirmation, then rush in after charts have already gone vertical, becoming the liquidity for smarter money. By the time influencers are talking about the coin, the asymmetric part of the move is gone because insiders are allocated, smart retailers allocated. They're one of the last to buy. FOMO is one of the most consistent edge leaks in trading and the easiest to avoid if you build conviction before the crowd. Poor price action reading. This is something I don't really hear talked about a lot. Most retail see price action as fixed patterns, head and shoulders, triangles, wedges. Elite traders understand that price action tells you a story. It tells you what market participants are thinking, who's trapped, where does the liquidity sit, which side is exhausted. The skill takes years to sharpen, but it's genuinely one of the highest ROIs thing you can do if you want to be a trader in the long term. Without it, you're literally operating blind in the market. You're mistaking noise for signal and repeatedly entering at the worst points in the cycle. So, what do the 1% do differently? The disciplines of the 1% trader. Well, they commit to an archetype. Okay, they commit to an archetype. They know what they're doing. They know what the game is. They're either long-term investors and they play golf all day in Marbella. They're active traders and they're online 16 hours a day. Meme coin snipers, meme coin developers, builders. They choose a lane and they just sharpen it. Just like you should do, just like you're encouraged to do in the modern economy. You don't go to university and they say, oh, just do a bit of everything. No, you're told do engineering, do doctor, be a politician, whatever. You go in your lane. It's the same with crypto. Build a borrow system. Elite traders operate from proven frameworks. Beginners waste years trying to reinvent the wheel. Guys, the systems are out there. Just take a system. Like a system defines entries, exits, risk parameters, and review processes, which removes emotions from the equation. My system, a lot of my system is taken from my mentor called Tom Dante, who I worked with a lot in 2020. And he's an ex-professional trader. He worked in the Bank of England. Sorry, not the Bank of England, but he worked in London as a prop trader. And he still trades professionally. I believe he's got a very big prop firm now. He's the guy that taught me. I just took his system and I changed it and applied it to crypto. Okay. Risk management first. In my own trading, I always try and preserve capital. I never put myself in a position where one bad trade can just wipe me out. That's the mindset the 1% live by. Position size and hedging and stop losses are not optional. They're foundational. Retail treats risk management as a footnote. Oh, just whatever, risk management, okay. Oh, okay, I'll just lose all my money. No, treat it as a necessity. Capital is your lifeblood. Losses is tuition, like I was saying. Every trader pays tuition to the market. You are going to have to pay some tuition, unfortunately. I've paid a lot of tuition to the market. Every serious trader has. Every loss is data. You should document what went wrong, what you need to change, and what needs refining. A lot of retail sees losses as failure and either chase recklessly to make it back, or deny the lesson entirely. The discipline is in using losses to improve the system. Informational flows. The 1% knows that informational flow is the biggest. It's the biggest edge. Okay, what is informational flow? Well, it's placing yourself upstream in the chain of cultivating private groups, trusted peers, and connections with builders and insiders to actually get information about what's going on in the market. Retail waits for KOLs to tell them what's happening. Elite traders hear it from the source. The stag hunt. So the best of the best in crypto don't operate as lone wolves. They treat trading and investing like a team sport. They surround themselves with a small pod of trusted peers. The concept is like a stag hunt. So you can chase rabbits alone and survive off scraps, or you coordinate and you work together to take down a big stag. So you got to operate in teams of like 3 to 5 trusted traders, investors, and you each act as an extra pair of eyes and ears. This network effect multiplies awareness, reduces blind spots, and compounds edge. More eyes, more brains, more alpha. Relentless reflection. I'm constantly reflecting on my actions, my decisions. I go for a walk daily just to think about my trades and what I did well, what I did badly. I keep a journal. I run post-mortems. You have to reflect on the decisions that you made so that you can make it better, because you're always improving. I'm still improving now, so you can sharpen the blade even further. And the last thing is emotional discipline. It requires you from taking your ego out of the equation. It requires you to just be calmer. Understand that losses are part of the game. Understand that you're not going to win every trade. Don't get too euphoric when you win. Don't get too sad when you lose. Keep in that middle ground. Keep detached. Distilling the edge. So at its core, it's discipline, asymmetry, and informational flow. And the 1% execute without hesitation. They cut losers quickly. They take profits systematically. They don't let emotions dictate decisions. For retail, the lack of discipline shows up as hesitation, greed, and fear, all of which erode performance. Discipline is what turns randomness into consistency. Learning this has taken me years. You can't skip the process. You have to go through it. Asymmetry is the filter you have to use on every setup. Is the upside multiples larger than the downside? The downside must be capped. Until you see an asymmetric opportunity, you have to stay patient. Pass on dozens of mediocre opportunities until you see the right setup. By contrast, retail always wants to be in a position, always wants to be in, and it guarantees long-term underperformance. Asymmetry is what allows the 1% to compound edge while taking fewer bets. And that's what separates those who win and those who bleed. Informational flow is the multiplier of all other skills. So you can be the best trader, but if you're not in private groups, trusted networks, don't have a team around you, you're always not going to have the biggest edge. You can get some idiots that are in private groups and that are in trusted networks, and they'll outperform the best traders. So please take this in mind. Network, get into groups, be active, okay? So when I distill my edge, it just comes down to 3 pillars. Discipline, asymmetry, and informational flow. On top of that, I sharpen price action and narrative recognition. That is my personal edge. However, without the pillars, nothing else compounds, guys. Watch back this video, take some notes. I hope you guys enjoyed the video. If you have any questions, just leave them down below in the video. I respond to every single one of them, okay? Have a lovely day, guys. Bye-bye.